So, today we should talk about funding and especially long-term funding. So, there will be also one class about short-term funding when we are saying that how cash management and survivability until realizing revenues and until just we are accumulating expenditures can affect the company, but not today. Today and also next time. After the spring break, we will talk about long-term funding with equity, with debt, with bonds, and also how to use financial lease contract. And at the end of the day, for us economists, what matters that return on equity should be high. So at least not zero, and not a negative number, so a positive number. What is expected there, because at the end of the day, shareholders were investing into this company because they wanted some kind of a revenue. Okay, but so in case of equity financing, what matters a lot that is this public or private equity. So are we funded through stock markets? Because in this case it will create us, first of all, or reporting, financial reporting and non-financial reporting will be way more details. It should be way more frequent about the company. We have to be really careful what kind of informations are disclosed by the company. So obviously, if we should not allow insider trading, so managers, when they know that some kind of an internal decision was made or will be made, they cannot make their own trades before the market has this. So before official communication. So public listing has its own perks, but also at the same time we can sell assets on a market, and it means that we can increase the shareholders' base drastically. And not just for individual shareholders, which is usually quite narrow, but we can sell shares to investment funds, we can sell shares to other institutionalized investors, which is nice because sometimes they have absolutely no intention to affect corporate operations. I will talk about it later. So, for example, ETFs, they don't care about corporate profitability. They are just buying shares because the underlying index behind the exchange-traded fund purchases or contains this share, so that's why they have to purchase it. But otherwise, corporate profitability doesn't matter. But if we have, so the main rule is that if someone's ownership in the company exceeds 10%, first of all, you have to announce it that now I'm a significant shareholder. Then the second thing is that they can delegate members to the board. So they will have some kind of a strategic influence at the end of the day. Until this one is a financial investor, so they are interested in share value growth until they are just invested in dividends. So they would like to have more money than before. Then it's still a great, so it's still okay. If it's a non-financial investor, so they have strategic interest in the company, but not just in case of profitability, but also in the case of the underlying product and services portfolio. So because they are technical investors, not just financial investors, then it can have further impact on the strategy itself. Or in some cases, it can happen that we are just operating a joint venture company, which is partially owned by some local company and partially owned by a foreign multinational company. And just in this case, our degree of freedom will be absolutely limited. So equity funding is a nice thing. And also, if it's a private company, then we have other kind of investors. They are private equity. And nowadays, in the last 1.5 decades, private equity firms became really popular. And also they made many mistakes if we are just thinking about SoftBank and other of these venture capital funds like entities. So that's why I have to talk about them today as well. Or we can have external funding, so debt and bond funding. In this case, we are completely affected by inflation expectations. We are completely affected by central bank monetary policy. We are affected by everything what is happening at the bond market, and also what is relevant for us, and from last time, from last lecture, that what is happening with our credit rating, because it will create or define not just the interest payments of the company, but the yields, and that's why also prices of the bond. So, and it's relevant for us. On the other hand, if we are issuing a bond, at least it can be a relatively simple way to collect funds, because in this case, okay, we have to pay some money for organizing this bond issuance for an investment bank. But once they are organizing it, then we are selling the bonds, and after that, we don't have to care about this anymore. So if the company is not publicly listed, we don't have more frequent reporting. We don't have to care about much about the bondholders, like as they should be shareholders. In case of bondholders, we just have to pay for the credit rating from year to year. There is an annual fee for that. We have to pay maybe for the bond market to enlist the bond, but otherwise we don't have to do anything further. We just have to utilize this external capital. Obviously, the problem is that compared to shares, we are just paying dividend only for the shareholders if the company is profitable, and also if the annual shareholder meeting accepts that the manager offers that, okay, we would like to pay some kind of a dividend instead of reinvesting into the company. So practically at the end of the day, sometimes shareholders are saying that we don't need dividend, please reinvest it into the company, because the company's profitability and ability to improve its profit, it's way better than what we can get as a dividend, and then if you are investing or dividend, that will be way poorer than just keep it into this growth-oriented company. So in many cases, they are just reinvesting, and shareholders realizing their profit not from dividend payment for many years, but from the anticipated share price increase. But in case of bonds or loans, then doesn't matter what is happening with the profitability or growth of the company, we have to pay always the interests of our debt. So in this case, this is regardless what is happening with our profitability. And it depends on the type of the loan and the bond. In case of loans, usually we also have to pay some capital. In case of bonds, in many cases it can happen that we don't have to pay any kind of a capital until the bond expires. Then at the time of expiration, then we have to repay the capital as well. But until then, we can use this capital. And obviously, there is a strange concept that people are saying that, oh, the company should repay its debt. No way. In this case, it would mean that we are also losing assets. So if I'm just realizing a lot of cash revenues for 10 years just to repay my expiring bond, then both obviously my liability side in the balance sheet will decrease, but also my assets will also decrease, and it would be completely useless. Or if it would, I would be forced to sell any other assets, so not just converting cash, but also some short-term or long-term assets. So that would be nonsensical. So usually what you have to do as a company, not to repay your debt, but before the bond expires, you are issuing a new bond, collecting the necessary capital. Then from this capital, you are just repaying the previous bond, and you can still maintain the size of your balance sheet. So this is one crucial thing in finance, that to grow a company, to make it bigger, your balance sheet should grow. If it's decreasing, then it means that you are suffering from deleveraging. So leverage means that we are using external funding, so debt or debt-like liabilities. And if we are not doing it, then it means that we are in serious trouble in case of, so maybe there is a financial crisis, so we're not able to take up a loan or not able to issue a bond, or we are able to issue a bond, just the prices are so terrible that we don't want to collect this, or there are other problems. So usually balance sheet should grow, and that's why we have to renew our debt. So this one is another crucial concept. Okay, otherwise, so corporate value should be neutral on the type of the underlying funding channels. So it doesn't matter. So the companies doesn't more valuable if you are just funding through equity or bonds. Okay, it would be nonsensical, but so it doesn't have any contribution. What matters, according to Modigliani and Miller theory, that we have to identify the prices, price of equity, so the expected return from equity. Also, we have to identify the price of utilizing a loan or a bond, in this case the interest rates, and then we have to optimize their utilization. This will contribute to the valuation, and this is what we can see in the discounted cash flow model. If you remember that for future cash flows, what is generated by the company in the future, we have to take the discounted value of such cash flows, and to do the discounting we needed some kind of a weighted average cost of capital, which is defined by equity and or debt. So at the end of the day, this is why we are doing it, and that's why until we can get cheap financing through debt, then it's way better than issuing more shares, because if you are issuing more shares, then the problem is that we have to sell it not just for external investors, but this will create a dilution. So we are diluting the shares of the initial investors in the company. So they were providing funds for us in the past, and now they can see that, okay, their relevance decreases, which means that their chance to realizing high dividends in the future when we are rich and profitable will decrease. So in many cases, equity issuance was rejected by shareholders meeting because they were saying that no, please don't do any kind of a dilution, please utilize bonds. And yeah, so let's go forward. The book says that, okay, if you have a multinational company, we have some features. So first of all, by being multinational company, obviously we are operating on multiple markets, so not just one market, to realize revenues, some expenditures, but also more of them. So hopefully our cash flow situation will be more diversified, and that's why more stable. But also, if we are not just operating on multiple markets, but also we can tap multiple capital markets. So it can be also beneficial that if we are operating in different capital markets, then maybe we can identify that, okay, if I'm operating both in the Hungarian market and both in Germany, then I don't want to take up a loan in Hungary for 10 or 8% of interest rate as a company. I think this is reasonable because government bonds are running at 7-ish % of interest rate. So for a company, 8%, 10% is realistic in Hungarian forint, while in case of Germany, we can do it for 2%. So obviously, again, a portfolio choice of debt is highly relevant for us, but in this case, we can at least have the option to choose. That's why lower credit risk can be identified in this case. Also, since we are operating on multiple markets, then if we are profitable already, so we have retained earnings, so past earnings, but is reinvested into the company, not paid out as a dividend. Then also we can look for, or we can select from different projects, and we can select that, okay, which one should be selected. And in this case also we can optimize our operations, we can focus on different markets, and we can select them better. So practically it's a portfolio management just in case of projects. Then parent company backs the debt of its subsidiary. This is a tricky question. So until this subsidiary works well, until the political risk is low or reasonably low, then it's reasonable to say that, okay, if I'm opening a new company in a new market, this company doesn't have assets, so obviously it will be really hard to provide any collateral for the bank to get this loan. And since we are a newcomer, then obviously our risk level will be higher, or at least what the bank sees, then their exposure will be more riskier. So obviously the interest of this loan will be bigger. So even if you are not considering a Hungarian case where the interest rates are generally higher than the Eurozone, still if you are thinking about two countries with similar interest rates, still if we are opening something new, then there the interest rates will be bigger. So usually what is happening there, that parent companies are providing funds for their subsidiaries. These funds can come from equity. Right now this is what we can see. So a Chinese battery manufacturing company, CATL, is now not just building, because they are really close to finishing this plant near Debrecen, so the other big city, other rural big town in Hungary, city. Okay, and in their case, it's quite visible from the books that they provided some initial capital, but right now they were issuing even additional shares on Hong Kong Stock Exchange just to increase the equity of this subsidiary way more. So in the past we were talking about hundreds of millions, now we are talking about billions of equity. So in this case, okay, it was equity provision, but also providing debt to subsidiary, it can be sometimes misleading, because this debt, so we have to check that what is the interest rate behind this debt, because sometimes the interest rate is just set to 0. So they don't pay anything for this debt for the parent company. But the parent company says that if they would like to optimize their tax payments, then obviously if you are paying dividend after the equity, before paying dividend, we have to pay corporate income tax. If we are paying interest for the lender, which is the parent company in this case, then we have to pay it before. So this will be just an expenditure. So in optimal circumstances, if the tax authority is completely blind, then we can set up the capital structure of the company by providing this debt from the parent company, that our profitability will be 0 because we are removing all the profits before paying any taxes, and then we can avoid tax payment. This is not elegant. This is sometimes considered completely illegal, but still multinational companies are trying to do this. And also, if you are finding it during a valuation, and then it's always much better and much more reliable to consider this as part of equity, because this is coming from parent company. Until the interest rate is set to 0, then it's behaving as an equity. So it doesn't provide voting power, but if the parent company is the sole shareholder, then this is equity-like liability. So in this case, we have just to put it into the other bucket. Okay, country characteristics. Yes, I talked about this one already. Tax laws, yeah. Then, cost of equity. So, Cost of equity, unfortunately, this is highly a theoretical phenomenon. So we can have some approximations about this. This is what we were able to see in the capital asset pricing model, so CAPM model, where we can see that theoretically, according to wise economists, the cost of equity should compensate at least the risk-free interest rate, and also still we have to see that what is the difference between the market average rate of return and the risk-free rate, and based on this risk premium, then we can set up industrial or corporate related weighting, so we can say that this company is more risky than the market average, then the beta will be bigger, or if it's less riskier because in a defensive sector like medicine or some sectors which are more robust to business cycles, then this beta can be lower, so or cost of equity can be lower, but at least the base rate should be the risk-free rate. So government bonds are defining the lowest level of cost of equity, and we have to be above it because otherwise it would be unwise to provide any kind of fund for this company. Yeah. Then private equity. So private equity, they should be professionals. Just nowadays, if we are thinking about WeWork and other beautiful examples from the last 10 years, this professionalism can be sometimes misunderstood. Unfortunately, the big phase of public equity, when all these quantitative investment schemes were popular in the industry, this mostly ended with the 2008 crisis. So the entire 2010 was about that if you would like to earn cheap money as a fund manager, you just have to create an exchange-traded fund. And nowadays, half of the investment fund market or mutual fund market is covered by these passive ETFs. The other remained active, but also we can see that there was a boom in private equity. Why? Because in this case, this should be a careful investment. So originally, venture capital firms were, or they became popular at least during the 80s in the US, but mostly if we are checking any kind of humankind's history, since we have some kind of markets and companies there, or company-like operations, venture capital was always there. What they are doing, that they are providing funds for long run. So the thumb rules are the following, that there is a venture capital firm with highly professional investors to identify companies and to know how to grow within the specific sector of interest. Then they are organizing at least one venture capital fund. Usually they have more funds, but let's say it's one fund per firm. And they are collecting funds, or at least pledges of funds, but let's say that, okay, they are collecting all the money right now from long-term investors like pension funds, private citizens, or other long-term investors. But these are closed-end funds, so they are keeping the money for 10 years. At least this is the general rule. So until 10 years, you are not able to request back your funds. You can sell your share in this venture capital fund, but you are not able to liquidate your funds and take it back from the firm, from the fund. Okay, so now they have 10 years to deal with this investment. So the venture capital firm will identify companies with huge growth potential. Or at least if they should identify companies that, not just startups. So the biggest misconception is that venture capital firms are focusing on startups. No, only 5% of the capital is invested into startups. Majority of the firm is invested into already existing companies, which are crap. So this is the best definition. So companies which had assets already, just they were mismanaged, they were overextended, they have many divisions, many of them are completely useless, but we can find some hidden or not so hidden gems that if we are just taking out this asset, this division, this product line, and sell the other for some money, we don't care about them anymore, then this can create huge revenues for us. So this has the potential for growth again. So it's like when you have a huge plant and you are cutting all the things off which are useless, and then this plant starts to grow again because now it has proper resources and soil and so on. So this should be the concept. So venture capital firms are completely deep into corporate strategies. So they are absolutely involved in strategy making for the target firm once they acquire a majority package. So you can see this 30 to 50% ownership, what is there in their hands. And also they are delegating managers to the firm. So they should have HR capacity. So they should know that, okay, if we would like to grow in this industry, then who are those people who we should hire to have a good financial manager? We need, because usually, even if you are thinking about startups, maybe the owner, the CEO is a really good engineer, but they have no idea about finance, they have no idea about any other fields of economics. So you have to put all these necessary people. And it's much better if you have proper experience there. So, for example, SpaceX is the best example that Musk had a lot of money by selling PayPal, but he made also 3 beautiful explosions with Falcon 1 rocket. So they had only one rocket left, and after that they would run out of the financial runway, literally, because the liquidity would dry up. And before of that, he was able to hire Gwyneth Shotwell, who was working already for 10 years in the industry. She was working, I think, at Lockheed Martin and other places. So she's an economist, she's a manager, but after that she was able to see through the company and optimize its operations. So practically she is the head of the SpaceX. Musk is president and he talks with the media, but at the end of the day, she is the main relevant manager who does the job completely well. And after that, they were able to launch it. It was not exploding finally because she organized the processes well and also quality checks well. And after that, they got the NASA contract practically immediately after the successful launch. So that's why you need really or you depend highly on professionals. So venture capital funds can do this, but also they have a really limited range for operations. So that's why we can find this clustering behavior that Silicon Valley or other regions are highly popular for startups and other companies, because venture capital firms are usually prefer that their target companies should be within a 100 miles range, so within 200 kilometers, because in this case you can have daily contact with them. Obviously, since the internet, this can be this can be done more easier, but still in the literature we can see, or in reports we can see that still they prefer to be on site frequently, because obviously they are running a lot of risk. So after 5 years of careful growth and management and everything, they did their best, and then there are 3 options. So they have to close down their position. Usually this is the 5 year. Sometimes they can stay longer, but again, thumb of rule. So this liquidation event can happen that they can sell the shares, so they can sell the shares through an IPO, so they are enlisting the company on the stock market, or if the company was already listed there, then they are just selling their shares for the public, or they are selling it to another investor. It can be another company, so they are selling it to Google. If it's in the IT sector, it was also really common in the past, or to Meta, or Microsoft. And or if it's not so fortunate, then they can liquidate the company, which means that they are selling the assets, closing down operations, and that was all. So something should happen several years later, and this exit strategy will be highly relevant. Also, they are trying to be quite careful, so it's not, even if they are purchasing shares in the company, they are not paying everything immediately because risk management. So the companies usually are required to reach milestones. And once they are able to reach the specific milestones, usually this relates to customer base, or do you have the final product, not just a prototype, or you are able to produce, or are able to conduct mass production of this product. So you should arrive to these milestones. And if you are able to do that, then you can get the next package from the investment. Also, in many real-life cases, they are not just buying equity, but they are also buying convertible bonds. So they are saying that, okay, right now this behaves as a convertible bond, but several years later, so they can set a time on it, or they can set, again, milestones on it that they have the option to convert it into equity. This is way more safer, because if the company would be liquidated, then debtors are always paid at first, and then what remains, then it will be given to shareholders. So again, this is for risk management. Yeah, nowadays VC market way more globalized than before. So nowadays we can see that there are many umbrella funds, and just local VC firms are trying to invest the umbrella funds money, and they are not doing it as a handmade stuff anymore like it happened during the 80s. Corporate merger or acquisition. This is an interesting feature because synergies. So you can find many nightmare scenarios when companies tried to merge and it ended completely terribly. So my famous example, or favorite example, is the Compaq and HP fusion was, because in this case they tried to merge two companies with completely different cultures, and at the end of the day the share prices were lower for the final company than initially it was, because their market share was shrinking altogether, so they were not able to realize any synergies. But there is always the story. So if you can see as an investor that suddenly one corporate share start to increase in value, and suddenly in the same industry we can see another corporate share start to rise, then there will be some kind of a story. We don't know what, but maybe someone will purchase someone else. If this is a merger, then this is peaceful. So both management is happy about it. They will identify that it will be better for them. Unfortunately, if they are doing it in the same market, in the domestic market, shareholders are not so happy. So in many cases, we can see that even share prices start to decrease. So, or at least not react so well on this great news that instead of having an oligopoly, now we will have a monopoly, or at least more monopolistic market. Because still they are just reshaping the same cake. It doesn't provide you much growth potential. Maybe you can cut some expenditures, but this is absolutely boring. So what is preferred by shareholders? That, okay, if they are merging together, at least they should merge in a foreign market. It's much more fancier because new markets are opened. Maybe there will be some kind of a technology transfer. So another company, one of the companies at least, can grow faster. So in this case, we can see some kind of a growth story, not just instead of having 2 fat cats, now we have 1 big fat cat. So, okay, Maine Coons are cute, but otherwise they are just eating way more. So the synergies can be an issue. If it's an acquisition, that's a different story, because acquisition can be hostile acquisition or it can be friendly. Hostile acquisition is when the management is not happy in the target company that they are acquired, and they can defend. And this can create huge wars on the stock market. So one of my favorite example about hostile takeover was BIC. You know, the sausage maker. That way. In Szeged. So they were a publicly listed company during the 90s, and they wanted to internationalize. So they were in negotiations with a new investor from Switzerland, and also they wanted to build a new manufacturing plant in Romania. So at least they tried to go cross-border, not just by exporting sausages, but also in terms of production. But the problem was that the management was absolutely technology-focused. So they were engineers, not economists. So they were raising a lot of cash reserve. And if you are having a huge cash reserve, this is always, okay, it's a nice thing, but also it's a bad thing, because in this case, sharks will appear in these calm waters, because they realize that if I'm buying this company from loan, from debt, and if I'm doing it quite aggressively, so fast enough before share prices would increase into the skies, then I can just take this cash reserve and then pay out as a dividend or take it somehow, and that's just repaying the loan which was required for this acquisition. And if I'm doing it well, then I can realize a profit also at the end of the day. So unfortunately, what happened in this case, that there was a private equity firm, and it was really careful. So they opened accounts at different investment banks, and then these investment banks started to purchase shares, but everybody was careful to stay under 10%, because in this case you have to announce it. We had friendly 9% shares, and during the next shareholder meeting, then they were announcing that, okay, now we are voting together, and poor management was fired immediately. So then the company was acquired, because after that the private equity firm was unifying its diverse portfolio of ownership, and then the story ended sadly, because then they were running the completely dry of liquidity. So several years later it was purchased by another investor who was interested in actually manufacturing sausages, not just to realizing cash revenues, but otherwise it was absolutely disgusting in case of ethics and other terms. But they were not able to defend themselves, because they had no idea that hostile acquisition can happen. There was another story in 2007. Yeah, that was the MOL ÖNV story, and still I can show the traces on stocko.com. No, this one. Because, yeah, 30? Yes. So MOL originally was a Hungarian, mostly monopolistic company. At least they have a monopoly in the field of refining oil. So it's only viable if you have a refinery to serve within a 300-kilometer radius, because after that its logistics would be too expensive. So usually in each small central European country has one refinery on its own. So sometimes more, but one is enough. And after that, during the 90s, they started to grow. So you can see the share price was increasing, then increasing again, because they started to purchase the Slovakian Slovnaft, which has a refinery near Bratislava. Nowadays they purchased INA, which is a Croatian company. And after that they had issues with that, but okay, so they had traditional portfolio. Also they purchased TVK, which was in plastics making, so they try to diversify, not just operating in the oil sector, but also in higher added value segments, which was really nice. So they built up something. Also they opened wells, or they purchased fields, oil fields, not just in the region, because mostly we don't have much oil or natural gas, but they had fields in Russia, in Pakistan, in Iraq, in Syria even, during the early 2000s, and they tried to drill their wells, and practically what they tried to do there, that to diversify their production. So even if they were selling the oil right after they were taking out from the ground in these countries far away, still they were able to finance their purchases of oil for their own refineries. So that was the deal. But one day we were able to see that, okay, after some growth story, shares started to go into the sky. So that was a really fast and really exponential growth. You can see that, yeah, for years we can see something, and then suddenly a jump in share prices. What happened that ÖMV, which is similar company just in Austria, but they are in the oil sector and they are doing completely the same thing, just the management and the language is different. They started to buy shares. And obviously the local management did not want it to allow hostile takeover. So they started to utilize also their own cash reserves. And practically there was a huge contest that who can get how much of the MOL shares. So the MOL was buying their own shares up from their own cash reserves. Also, they were asking OTP to do the same thing, so there was some cooperation with other firms. But at the end of the day, you can see that the volume of trade was enormous. So when you can see this, that trade volume increases, also share price increases, then this means that we are in a bubble or someone is absolutely defending against hostile takeover. So the publicly available shares, the number of them decreased so dramatically that after that, okay, they ended this story. So after that, ÖMV stopped at one point. They sold their package to a Russian company. Later it was repurchased by the government during the 2010s. And after that, MOL was sitting with a lot of its shares, but they wanted to be careful. So if they are just reselling on the market, then hostile takeover can happen again. So what can you do? Because you cannot hold your own shares for longer than 1 year. So after 1 year, you have to decide that selling the shares, or you have to just null them. So remove them from the balance sheet and zero them out. And after that, your equity will decrease, and also your assets will decrease as well, because it's useless to have your own shares for long run. And also illegal from accounting perspective. Or in this case, they created a company, or I can say hedge fund. So they created a special purpose vehicle, a special purpose company in Bahamas or somewhere in the Caribbean Sea. And MOL Magnolia purchased these excessive shares owned by the MOL. And MOL Magnolia at the same time issued convertible bonds. So they were saying that, okay, these bonds after 5 or 7 years can be converted to shares at the defined price. But the price was so high that it was quite nonsensical to do this conversion at the end of the day. But still, the bonds were paying really nice variable interest. So and at the end of the day it was quite lucrative for the investors to do this. Unfortunately, that was not for small or retail investors, because one bond was had a pair value of 10,000 euros, so I was out of question. As also I lost completely this rally, so when I realized that what is happening there, then the share price was already in the skies, and in this case you don't want to join. One of our friends joined, and after that he had to sit in the shares for nearly a decade until he was able to realize any profit on it. So, because after that, obviously, the 2008 crisis arrived, so share prices dropped down, then it was recovering, but still not pre-recession levels, and then we can see that this is maybe 2017, 18, then we can see higher share prices again. So if the dinosaurs are fighting, you should start at the beginning, or you should run away as a retail investor. This is my advice here. So these acquisition stories can be always interesting, that what is happening there. Yeah. Okay, public equity. What are the further features? Oh, yeah, so absolutely, yeah. So, during the 2001 crisis, Enron crisis, since we have SPX here. So, in the US, the whole 90s were about, and also in Europe, not just in this region, but also in Western Europe and in the US, was the whole 90s about privatization of companies, former state-owned companies, or privatization of market, or opening up of markets, which were previously completely regulated by governments. So they opened up financial sector way more than before. Also, they opened up energy sector. The whole internet was growing, and originally also telecommunication sector was supervised deeply by government. Obviously, during Cold War it was reasonable, but after some points it was quite useless, because these big fat telecom companies needed to be renewed, because technology was just stepping through them. So they needed huge investments to build up not just wire-based communication, but also cell towers must be built up. Server, at least supporting server capacities, had to be built up to provide proper internet. Then also fiber optics networks had to be built up to provide, again, proper internet. So all these investments into the basic infrastructure had to be done during the 90s to have now these cat videos available on YouTube today. And obviously some of these investments were quite useless, or their profitability expectations were over-exceeding reality. So what we can see here, that many companies in the IT sector, in the communication sector, or also in the energy sector like Enron, try to provide beautiful and pink views about what can be expected there in terms of growth. Enron was never profitable. They made the company profitable by reporting nicely, but after some levels they were reporting not so nicely, because they are falsifying their reports. So obviously what happened, stock market crashed already in 2001, and you can see this slump happened until many years, because investor trust was quite poor, even in US companies. Also in Europe, Parmalat did the same thing. That was a milk making company and some cheeses and so on, but they were trying to grow big. It was an Italian company, and it was an Italian multinational company, so they had production also here in Hungary. But management was always trying to defend themselves that, even if the reports were falsifying, we had no idea about this. This was just happening at the lower levels of the management. obviously lower management was always telling that, yes, but we were doing it by command, we were following command from upper management. So to solve this, Sarbanes-Oxley Act was created in the US that management, high management, should sign the financial statements, and by signing this, they became absolutely responsible for the validity of this. So if data is falsified and it's proved at the court that it's falsified, then they can be sentenced for 20 years in prison, as things should be. Unfortunately, since then, we are not able to see much of these prison sentences, but at least they tried. At least they tried award was given to the court and the lawyers as well, because nowadays if anything happens with a publicly listed company, which raises the question that maybe things were altered in their reporting, then they have to hire US lawyer firms, the expensive one. And with this premium package, they have to spend years. So even if they are not going to prison as a management, at least they are forced to spend a lot of money on lawyers for years. So at least this implicit cost of using or falsifying reports were at least made explicit, because now they had to spend on lawyers, and at least they are less motivated to do that anymore. So it happened with Hungarian Telecom. So Hungarian Telecom was a state monopoly company or state-owned company in the early 90s. Then part of the shares were purchased by Deutsche Telekom in the 90s, but also it was and still listed on the Hungarian Stock Exchange. But also it was enlisted in the US Stock Exchange in the early 2000s. So when there was a scandal that they purchased a subsidiary in Montenegro, in Crna Gora, in the Balkan Peninsula, and some issues were raised that maybe some bribery happened because of privatization, obviously. Then they had to bring their US lawyers from New York with a chartered airline plane to work there, to investigate, and then back home and again back and forth. And obviously, as a result, the local Hungarian management was fired by the German parent company because they made a huge error by not being careful enough. Also, the other feature of this WorldCom scandal or Enron scandal was Andersen's downfall, because before of this 2001 accounting falsifying scandals, you were able to use the same company for accounting and also for audit. So Andersen was literally falsifying the books in one office, and also they are verifying it that, oh, it's completely nice and reliable in the other office. So then Andersen was collapsing or imploding within overnight when Enron scandal happened. So before of that, nowadays we have this big four of Ernst & Young, Pricewaterhouse, KPMG, and with Deloitte. Yeah. So in the past, there was also the fifth one that was Andersen, just because they were writing beautiful tales. Then nowadays there is only four of them. And also nowadays, that's why they are separated. So nowadays you can only provide accounting or audit, but not both for the same firm. And also they are changing who does the audit. Not so frequently, so it's always a red flag that if you can see that a company is changing the audit firm annually. And also this audit firm is quite sketchy, so not the big four, but some really small local firm which is dubious, then it's always a red flag that they are falsifying something or they are nasty. Yeah. Otherwise, if you would like to be enlisted on the stock market, then you have to go for an investment bank, and then they will organize. So it requires a lot of paperwork. So that's why in many cases when people are doing IPOs, they can do this in this classical way, that investment bank does the paperwork, it prepares the company for the proper reporting. So mostly they have to make processes much more leaner in case of financial reporting to support this job, because now you have to provide quarterly reporting, not just annual report, and also you have to provide way more information, and also this should be valid. And also they are trying to convince investors through roadshows that they have to put money into this company. And once they are successful, still the investment bank should define the initial price. So what is the target price for the IPO before starting the trade? Also, sometimes they are selling some of the shares already to professional investors, so even before the trade starts. And also, which makes their valuation way more credible, that they are also buying some shares and creating some kind of a package. And after that, then we can tap the capital market. The fastest way is to having SPACs. So special purpose vehicle acquisition companies. So special purpose acquisition company, sorry, without the vehicle. So the SPAC is created by an investment bank, and then they are collecting funds from investors. Then within they have just several months to identify which company should be purchased to be enlisted on the stock market. Then they are purchasing the shares of this company, or at least the package of shares, and then they are selling. So they are merging with this private company, and then they are. And so the SPAC is already enlisted on the stock market, so they just have to continue this, which makes the whole procedure way faster. I can't say efficient, but fast at least. Or if they are not able to find a target firm, then usually they are just closing down operation after a year. Still, you have to be really careful because it's really easy to participate in a SPAC. But at the beginning, you have no idea what will be the objective. Maybe they are defining the industry, but that's all. So as a retail investor, it's not that great idea. And also in many cases, they are buying quite useless shares. So for example, one SPAC case was this rocket business. What was... Not Alpha. Who was flying sideways and orbits exploding? Okay, I'm not narrowing down exactly, but something with A. Yeah, but at the end of the day, their share prices melted so much that they were forced to delist from Nasdaq. So, and also Rocket Lab, which is flying frequently, they are generating cash. Now they are diversified, so half of the money is coming from satellite manufacturing. I think that there is maybe... Yes, there is data about them. Okay. Let's switch to maximum. So you can see here that there was the SPAC phase when still the company was acquired by the SPAC and the shares, and then they were enlisted on the market, and then we can see that there are years of struggling. So until they were scaling up their operations to build up their own whole manufacturing and launch complex in the US, in Virginia, not just in New Zealand, where originally the company started. Also, they had to diversify by acquiring small satellite manufacturers, and now we can see that, okay, now there is some kind of a growth in case of share prices, but this is a usual SPAC story. So if you can see that share prices are completely horizontal for some months, then this is the reason that originally this was a completely empty publicly listed company, and then they purchased the shares. Yeah. Okay, I talked about IPOs. Then let's talk about long-term liabilities. So, in case of long-term liabilities, what matters for us is the cost of debt. And this looks like as a cake, and also tomorrow I would like to show you this cake way more on class, because so first of all, investors are not stupid. So if they would like to purchase our bonds, then we should compensate them for inflation. This will be a built-in feature into the interest rate. Also, they should be compensated, so we should pay more than government bonds, because otherwise they would just pay or buy government bonds. So we should have some kind of a risk premium. But also the secondary problem is that not just the risk premium should be covered, but also if we are not in a AAA rated economy, but there is also some kind of sovereign risk because of the difference between AAA rating and our country's rating, that also there will be a sovereign spread as well. So practically the cake looks like that inflation plus what is happening, or at least what is happening in the German or the US government bond market, then sovereign premium, so the difference between German and the French or Italian government bonds, and after that still what is happening in this specific industry in let's say Italy, and how much more money we should pay as interest compared to the Italian government bonds. And after that still we have to compensate for maturity. So we are winning the whole yield curve, and that's why it's quite interesting to see and quite interesting to model what is happening with the interest exposure, because in recent years there were many issues with companies who were funding themselves through debt. So for years, let's go back to Tovari. Yeah. No, not Tovari. Obligacie. Yes. My Polish is terrible. But if we are focusing on France and the long-term yields. Oh, sorry. Now the story is about Austria. So I have to go to Austria. Then we can see that companies in Austria or in Germany, they were enjoying this environment where government bonds were close to zero in case of their interest. But that's why also as a company you were able to take up loans at 2%, maximum 3% of interest rate. So financing through debt, it was absolutely cheap. So for example, KTM, which was originally a company which manufactured bicycles and motor bicycles or motorbikes, they started to expand their operations. So they purchased Husqvarna, which is this chainsaw company, and they did also some other diversification, but they did everything from debt. And as you can see, due to COVID and other reasons, interest rates were increasing because inflation expectations were growing, central banks were reacting on it, and then now we can see that, okay, interest rates were increasing from nearly 0 to 3% in case of government bonds, so you can expect what happened in case of private interest rates for firms. So suddenly KTM was facing a near default situation. So if you are checking the internet and the news, then we can see that the company is struggling. So let's see KTM. That's alone. What news about KTM? No. Debt. Yeah, so we can find beautiful news like KTM Securities secures funding to pay off creditors. So many German and Austrian companies are facing the same situation, that somehow they must consolidate their debt. And also the next one is KTM files for insolvency, subsidiary higher debt. So yeah, what I mentioned already. But now they are maybe able to move from this sad situation. And also, if we are checking here the questions, related questions, can KTM survive restructuring? Maybe, yes. So they had to sell some of their subsidiaries, do something with that. But this is not just KTM specific or not just bicycles or chainsaws. It's a complex business-related issue that they were overexposed with interest rate risk, and now they are facing the price because some of these acquisitions were made because they wanted to expand their operations but not expand their profitability, and their profit acquisition was ended badly. So at the end of the day, they should reconstruct themselves. So that's why we will test during the next or tomorrow at the class that how exposed these companies are against interest rate risk. Because if the company is still profitable after we are checking historically highest scenarios in case of interest rates, then we can say that, okay, the company is robust. If not, at least we can see that what is the threshold, when after that we have to say that, okay, now we should do something with this debt. Luckily, the company in question, so Arianespace, has no debt because it's completely funded through equity by the two parent companies, but still we will check that what happens in this situation. Bank loan. Oh, and the last thing. So both bank loan and government corporate bonds can have fixed interest rates or variable interest debt. So obviously, if as a bond issuer, you are logged into this 2%, 3% loans, what were valid in this time period, then you don't care about all of these things. So you are just happily operating with your debt and laughing on the rest of the market. If you are running, or if you are issuing bonds with variable interest, then obviously you are facing trouble. So, in the case of variable interest, obviously, there is the benchmark interest rate. So this is always some kind of an interbank market rate loan. So in the past it was LIBOR. Then big banks were manipulating it in the 2010s. So that was a big scandal. Some people went to prison. And then nowadays central banks are trying to nationalize this indicator. So even ECB has its own variable interest benchmark. And based on this, so the corporate credit risk will be just added as 2%, 3%, some kind of a percentage based on this one. So, yeah. Investors are much more eager to purchase variable interest loans if interest environment is low as well, because at least you have a chance to have higher interest. And also, if interest rates are increasing, the price of fixed interest bonds are decreasing suddenly. So you can realize a huge loss as a bond investor if you have a big portfolio of fixed interest assets. If you are keeping until expiry, then it doesn't matter for you. But if you have to sell it, or if you are trading actively on the bond market, then this can be a big no-no. You don't want to involve in fixed interest. If the interest environment is high, then it's a good thing if you are logged into high fixed interest bonds as a portfolio. Just usually, in this case, debtors don't want to issue something like this. They would like to have variable interest lending, because at least there is the chance that sooner or later interest will decrease. And obviously, this whole thing is exposed towards business cycles. So if we are in a recession, obviously interest rates, until there is no inflation, interest rates will decrease, or if the business cycle is in a booming phase, or if there is sudden increase in inflation expectations, then this interest will increase as well. So practically we can estimate a nice Markov switching model on all of these things, and we can separate two regimes. One regime will be low interest environment, another regime will be high interest environment, and we can model them completely separately. So yeah, in case of bank loans, usually they are not for long-term funding originally. So these are much more like for 1 year funding. Sometimes we can see long-term, but mostly when corporate bond market is weak. So for example, in Hungary, since the market is really small, then you are forced to utilize only bank loans. But in proper sized economies with a really deep financial sector, then companies, or if companies are big enough, then they are always going to bond-based funding. When I was learning in the Slovenian Central Bank, even they told me that, or told us, that even Slovenian big companies are issuing bonds, not at home, but in Austria or in Italy, because they are neighboring countries and also they have good bank relations there, but it's cheaper. Or if they are taking up a loan, they are still doing it from Italian or Austrian bank because it's cheaper in terms of transaction fees. So, okay, after that there is some description about interest rates, corporate bonds, and the last thing that this is why valuation or credit rating matters. 4 minutes remaining, guys, 4 minutes. So this is what we can see here, that, okay, if you had a AAA rated company in the US, then doesn't matter that what kind of disaster happens on the bond markets, practically they were just paying happily the 5% interest rate in 2008 or in 2017, or if you are opening it, Fred. Luckily for the US, we have completely transparent data from the 20s. So in this case, okay, that was high inflation period, but if you are just checking recent times, then we can see that, yeah, it was always less than 7.5%, or it was always around 5%. So credit rating matters, because for AAA rated companies, this is perfect. If we are going into double B rated companies, which is not the junk bond territory, but something, then we can see that that's even adjusted. Option adjusted. Oh, this is different adjustment. Yeah, but at least we can see that now it was jumping more under a crisis. So it's the peak is 14%. Even during COVID lockdowns, the peak was 6%. And if you are going into the junk territory, which is C rated, triple C rated, then we can see that were facing troubles already. 18% during COVID, or there was this, I don't know what happened in 2016, but there was another shock. Or during the 2008 crisis, practically it was worthless to sell any kind of junk bond, because in this case, the yields were at 37%. So this is nonsensical. So that's the reason why we have to talk about, that's the reason why we have to talk about risk premium above government bond yields, because rating matters a lot. Also volatility, so not just the level, but also the volatility of the yields. Because sometimes we can see that, yeah, they are still at 10%, yeah, but they can be everywhere between 10% and 30% if things are going south. So, yeah. And that's all for today, because after that, next time, after the autumn holiday, we will have financial lease and all these beauties related to it.